Gas is still over $4 a gallon in America. So if the crisis is supposedly cooling down, why are people in some U.S. states getting crushed even harder at the pump? Because this story is no longer just about Iran, it's about which Americans drive the most, which states have no backup options, and why your zip code may decide how painful this gets. In the next few minutes, I'll show you which states are paying the most, why prices are still elevated, and what could happen next to your monthly budget. Let's quickly lay the ground truth, because the news cycle has been chaotic. In early March 2026, the Trump administration launched military strikes on Iran. The stated goal? Neutralize Iran's nuclear program. The immediate consequence? The Strait of Hormuz, a narrow waterway at the mouth of the Persian Gulf, effectively shut down. Here's why that matters in one sentence. 20% of the world's oil passes through that strait every single day. Before the war, about 100 oil tankers moved through it daily. Since the strikes, around 20 per day, with hundreds more sitting in the water, waiting. Imagine a highway with 5 lanes that suddenly got narrowed to 1. That's the Strait of Hormuz right now. Brent crude, that's the global oil benchmark, jumped 30% almost immediately, crossing $100 a barrel for the first time since 2022. Now, the ceasefire. The U.S. proposed one. Iran publicly rejected it. Oil ticked back up the same day. Even if a real ceasefire were signed tomorrow, the damage to global supply chains doesn't vanish overnight. That's the first piece of the puzzle. Let's build the full picture. You've probably heard that oil prices are about supply and demand. That's true, but it's only half the story, and the other half is the part that explains why prices spike fast and drop slow. Let's start with supply. The world produces about 100 million barrels of oil per day. The U.S. is actually the largest single producer in the world, around 13 million barrels per day. Saudi Arabia and Russia are close behind. So here's a question I know you're asking. __quote_0__. Because of a decision made over the last decade, the U.S. built infrastructure to export oil. Pipelines, terminals, refineries, all connected to overseas markets. That means American oil now competes in a global market, and global markets price oil globally. When the Strait of Hormuz closes, the global price goes up. And when the global price goes up, your local gas station adjusts its prices to match, even if every drop of gasoline in your tank was refined in Texas. This is what economists call, quote, one. You're connected to the Strait of Hormuz whether you've ever heard of it or not. Now demand. We are heading into spring. Historically, gasoline demand in the U.S. rises between March and August. People drive more, travel more, buy more. Oil companies and traders see this coming and price it in. So even without a war, spring tends to push prices up. The war is landing on top of already elevated demand. And here's the stickiest part. When oil spikes because of a geopolitical event, it takes months for the market to fully adjust, even after the event ends. Inventories need to be rebuilt. Alternative supply routes need to be established. Refineries need time to adjust their inputs. Insurance costs for ships going near conflict zones stay high for a long time. The 1973 OPEC embargo? Gas prices stayed high for over a year after the embargo ended. The Russia-Ukraine war? European energy prices were elevated for nearly 18 months. A ceasefire is a news event. The oil market is an infrastructure reality. And infrastructure doesn't move at the speed of news. Okay, oil is expensive. Gas is expensive. We know that. But let's trace exactly how this hits your actual life. Because most people stop at the pump, and the pump is just the beginning. Link 1. Transportation. The national average gas price has gone up over $1 per gallon compared to a month ago. For someone who fills a 15-gallon tank twice a week, that's $120 more per month. Just gone. If you drive more than the average, longer commute, rural area, bigger vehicle, you're losing $150, $200 a month. That's a car payment. That's groceries for a week. Link 2. Groceries. Almost everything you eat was transported by truck. Trucks run on diesel, which is also spiking. When freight costs go up, food companies raise prices. You already saw this movie in 2022. Transitory inflation that didn't feel very transitory. There's also the fertilizer angle. The Strait of Hormuz carries up to 30% of global nitrogen fertilizer exports. Nitrogen fertilizer is what grows corn, wheat, and soybeans, the backbone of the American food supply. A prolonged closure doesn't just raise your gas bill, it eventually raises the price of bread. Link 3. Utilities. Natural gas, which heats about half of American homes and generates a significant share of electricity, is also traded globally. Historically, LNG prices track crude oil prices with a slight lag. Expect your utility bill to creep up over the next 2 to 3 months if current conditions hold. Link 4. Everything shipped. If it moves, it costs more now. Online orders, appliances, electronics, the cost of moving goods around the world is baked into every price tag. Retailers absorb some of it. They pass the rest to you. Link 5. Your employer. This one's slower but real. When energy costs rise, company margins shrink. That can mean hiring freezes, smaller raises, or in severe cases, layoffs. The Penn-Wharton analysis found that if oil stays above $100, GDP growth slows and unemployment starts to tick up. It's not immediate, but it's a real downstream risk. 1 barrel of oil, 5 ways it hits your monthly budget. And most Americans are only watching the gas pump. Real quick, if this kind of breakdown is useful to you, hit subscribe. We do this every week. Take a big macro headline, trace it all the way down to your actual paycheck, and tell you what it means. No jargon, just the chain of cause and effect. Also, drop a comment. How much more are you paying at the pump this month? I want to see where this is hitting hardest. Okay, let's keep going because this is where it gets really specific. Not all Americans are feeling this equally, and the data on this is pretty striking. The Institute on Taxation and Economic Policy ran the numbers. Across the country, American drivers are spending an extra $9.4 billion per month because of higher gas prices. Let that sink in. $9.4 billion. Every month. Gone. Nationally, the average hit is about $34 per driving-age person per month. But the South? $39 per person per month. And some states are way above that. Alabama, Mississippi, Wyoming, Kentucky, New Mexico. Why these states? 3 reasons. First, longer commutes. Rural and semi-rural states mean people drive farther just to get to work, to the grocery store, to school. Second, bigger vehicles. These states have some of the highest rates of truck and SUV ownership in the country. A Ram 1500 getting 15 miles per gallon hits a lot harder at $4.50 a gallon than a Civic getting 35. Third, no real public transit alternative. If you live in Manhattan and gas is $5 a gallon, you can take the subway. If you live in Tuscaloosa, you drive. There's no other option. Now flip to the other end of the spectrum. Who's most insulated? The Northeast pays less per person, not because gas is cheaper there, it's not, but because people there drive less. New Yorkers ride the subway. Bostonians take the T. The infrastructure absorbs the shock. Here's the cruel irony. The states being hit hardest, Alabama, Mississippi, Wyoming, are also among the states with the lowest median incomes. So the people who can least afford a $50 monthly shock are the ones absorbing the biggest one. That extra $52 a month in Alabama? That's $624 a year. For a family on a $45,000 income, that's 1.4% of their take-home. Gone. Before they've bought food, paid rent, or kept the lights on. This is what it means when economists say energy shocks are regressive. They hit the people with the least, the hardest. All right, what actually happens from here? Let me walk you through 3 realistic scenarios because the outcome is genuinely uncertain, and anyone who tells you they know for sure is lying. Scenario 1. Ceasefire holds. Strait reopens. 60 to 90-day recovery. If a real ceasefire is agreed, the Strait of Hormuz starts reopening within days. Oil tankers that are currently waiting begin moving. But here's the thing. Restoring full flow takes weeks, not hours. Insurance for ships in that corridor stays elevated for months. Inventories need to be rebuilt. Historical precedent. When tensions in the Strait eased in 2019, it took about 6 to 8 weeks for prices to meaningfully come down. In this scenario, gas prices could be back closer to $3.25 to $3.50 by late summer. Scenario 2. Conflict drags on, $100+ oil through fall. This is the scenario most energy analysts consider most likely right now. The strait stays effectively closed or severely restricted. Oil stays above $100. In this case, you're looking at another $1 plus per gallon through at least September. Annual household cost: $800 to $1,200 more per year versus a year ago. Inflation ticks back up, especially in food and energy. The Federal Reserve faces a nightmare scenario: raise rates to fight inflation, but the economy is already slowing because consumers are spending more on gas and less on everything else. Barron's analysis suggests the real economic damage kicks in if oil stays above $125 a barrel. We're not there yet, but the risk is real. Scenario 3. Escalation. Straight mined, $120+ oil. The worst case? Iran follows through on reports that it's mining the strait. Daily tanker traffic drops even further. Oil spikes toward $120 to $130. We start seeing gasoline rationing conversations. Economists start using the R word openly. This scenario isn't the base case, but it is a non-zero probability. And markets are pricing in some of that tail risk right now, which is part of why prices haven't dropped despite the ceasefire talk. If you're planning your budget, Scenario 2 is the prudent assumption until you see actual evidence of Scenario 1. Let's talk about what you can actually do. Not vague advice, specific, practical moves. 1. Time your fill-up strategically. Gas prices tend to be lowest on Mondays and Tuesdays, and highest on Thursdays and Fridays before the weekend. Use GasBuddy or the Gas app to find the cheapest station near you. On a 15-gallon fill, this can save you $3 to $5 every time. Doesn't sound like much, but that's $20 to $30 per month. 2. Evaluate your driving patterns now, before prices get worse. Can you consolidate errands? Combine 3 separate trips into one loop. For every 5 miles you don't drive, at current prices, you save about 75 cents. If you're driving 1,000 miles a month, cutting 10% saves you $15 to $20 right there. 3. If you invest, understand the energy sector. Oil companies are having a very good year. If you have a 401k or brokerage account, your energy sector exposure may be up significantly. This isn't investment advice. Talk to a financial advisor. But know that the pain at the pump is someone's profit somewhere. 4. Watch for government relief measures and don't get fooled. Gas tax holidays are being proposed in several states. Here's what you need to know. They sound good and do very little. In Georgia's recent gas tax holiday, the bottom 60% of households received on average just $13 per family in savings. 40% of the benefit went to people who don't even live in Georgia, tourists filling up passing through. The oil companies capture most of the benefit when refiners and retailers don't pass the full savings along. Be skeptical of any politician claiming a gas tax holiday is the solution. 5. Hedge against grocery inflation proactively. If fertilizer disruptions lead to food price increases 3 to 6 months from now, a real possibility, buying shelf-stable staples now at current prices is a legitimate hedge. Rice, beans, canned goods. Not doomsday prepper stuff, just smart timing. Let's bring it all together. Iran called a ceasefire. Oil is still $100, and you now know exactly why, and exactly what it means for your life. The Strait of Hormuz is still effectively closed. Ceasefire talks mean nothing until oil tankers are actually moving again at full capacity. Even when they do, recovery takes 6 to 8 weeks minimum. Meanwhile, American households are paying $9.4 billion more per month in gas alone. The hardest-hit states, Alabama, Mississippi, Wyoming, Kentucky, New Mexico, are disproportionately lower income and more rural. The chain reaction from oil hits groceries, utilities, and eventually your employer's bottom line. The 3 scenarios: quick recovery, prolonged pain, or escalation. Plan for the middle one until reality proves otherwise. And the moves you can make right now. Time your fill-ups, reduce discretionary driving, understand your investment exposure, ignore gas tax holiday hype, and hedge your grocery bill if you want to be proactive. This is what Dollar Decoded does. Every week, we take a headline that feels far away, a war, a rate hike, a geopolitical crisis, and we trace it all the way down to your specific, real, dollar-denominated life. Because the macro always ends up in your wallet. You just need someone to show you the chain. If that's valuable to you, subscribe. It's free, and it means you'll never be caught off guard at the pump again. Drop a comment. Which of the 3 scenarios do you think plays out? I'm genuinely curious. I'll see you next week.